options trading, yeah, it can feel like a bit of a puzzle sometimes, can't it?
Definitely. Lots of moving parts.
So today we're doing a deep dive into a specific angle from Mansi, focusing on Nifty 50 options. Basically, trying to figure out, when should you buy and when might selling be the better play?
Exactly. And the core idea revolves around two things. Volatility, we'll use India VIX for that, and Bollinger Bands.
Right, those lines on the chart showing the price range based on the moving average and standard deviations.
They give you a visual sense of how volatile things are.
Okay, so let's tackle buying first. When does this strategy say go buy?
Well, the conditions are pretty specific. You're looking for volatility that's increasing, and you want to see the Bollinger Bands widening out. The source calls it a spurt.
On which charts are we looking?
Mostly medium to shorter time frames. So like hourly, 4-hour, maybe even down to 15-minute or 5-minute charts for entry points, possibly daily for context.
And why does that combo matter? Rising VIX and widening bands.
Because rising volatility, so a spiking VIX, often means bigger price swings are expected. That tends to make options themselves more expensive, but it also signals potential for a larger payoff if you guess the direction right.
Okay.
And the widening bands, well, they visually confirm that increased activity, the market might be about to break out.
Got it. So let's use the example. Nifty's at, say, 24,000. India VIX suddenly jumps maybe 15 up to 25.
Like jump.
Yeah. And on the hourly chart, those Bollinger Bands expand. They were maybe plus minus 200 points. Now they're way out at plus minus 500.
Right. And then, crucially, Nifty breaks out of that band. Let's say it pushes above the upper band at 24,200, and importantly, volume picks up too.
So the play here is, if you think it's going higher, buy a call option.
Exactly. Or if it broke below the lower band, you'd consider a put option.
So the example is buying a Nifty 24,200 call, expiring in a week, costs you maybe 150 premium. And if Nifty does run up, say to 24,500, that option premium might increase significantly, maybe to 350.
Right. So you've potentially made a good profit. And the key thing with buying, as you said, your risk is limited, right? It's just that 150 premium you paid initially.
Per lot, that could be, 50 units times 200 profit, 10,000 profit versus 7,500 risk?
Something like that, yeah. So high rising VIX, widening bands, think potential big move, consider buy.
Okay, clear. Now the other side of the coin.
Yeah.
Selling options. When does that look attractive?
This is almost the opposite scenario. You're looking for volatility that's declining, and you want to benefit from time decay.
Theta. The option losing value as expiration gets closer.
Precisely. So if the market isn't expected to move much, selling options lets you potentially collect that decaying premium.
So what does that look like on the chart?
Think consolidation. Nifty might be trading sideways, maybe around 24,000 again, but on a daily chart this time, suggesting a longer period of calm.
Then the Bollinger Bands?
They'd be narrow, perhaps only plus minus 150 points. And the India VIX would be dropping, say, from that high 25 back down towards 15.
Maybe other indicators confirm it too, like a low ADX suggesting no strong trend.
Yeah, exactly. Low decreasing volatility, narrow bands that points towards a range-bound market.
So the strategy here is
Selling out of the money options, OTM calls, OTM puts, or maybe both in a strangle.
like selling a nifty 24,200 call that's above the market for maybe 100 premium, and also selling a nifty 23,800 call put below the market for, say, 90. Both expiring soon, like in a week.
Right. You collect both premiums. The bet is that Nifty will stay between 23,800 and 24,200 until expiry.
And if it does?
Then both those options expire worthless, ideally. And you, the seller, keep the entire premium collected up front.
So 100 plus euro, that's 190 profit per lot.
Yeah, which could be 9,500 profit per Nifty lot in that example.
But there's risk here too, right? If Nifty does make a big move outside that range.
Absolutely. Selling options, especially uncovered, carries potentially significant risk. If Nifty shot up to 24,500, that 24,200 call you sold would be in the money and you'd face losses. It's not limited like buying.
Okay, so let's recap the core idea.
Sure. Buy options when volatility is high and rising and the bands are widening, suggesting a breakout is likely.
Sell options when volatility is low and falling, bands are narrow, suggesting a range-bound market where you can collect premium via time decay.
That's the essence of it. And always remember that risk difference buying is limited risk. Selling can be, well, theoretically unlimited if unmanaged.
Good point. And for people wanting to track this stuff.
Tools like TradingView are great for charting Bollinger Bands. And the NSE India website, ncindia.com, that's where you find the official India VIX data.
Right. And selling requires margin. That's important to check with your broker.
Definitely. And please, practice this on a demo account first. Get a feel for it before putting real money on the line.
Absolutely. So here's a final thought to chew on. Beyond just options, how could understanding this interplay between volatility and Bollinger Bands change how you interpret market sigils generally?
hmm And what other technical tools could you maybe layer on top of this approach? Thinking about risk, reward, and market conditions, it applies way beyond just this one strategy, doesn't it?